They add to the compound interest rocket ship that I'm currently building out on my launch pad. What's up, everybody? My name is Zach Bai, and on this channel, I worry about money so that you don't have to. Today, I want to talk about what's become a slightly controversial part of investing, something I never would have thought: dividends. I'm going to break down what a dividend is, the pros and cons in investing in dividend-paying stocks, and what you should do when you finally get paid that dividend. Should you reinvest it, or should you take that money and run? So, without further ado, let's get going. First of all, what is a dividend? Well, a dividend is essentially a share of a company's profits that's paid out to you, the shareholder, for just owning the stock. You don't have to do anything else, and if you own a stock that pays dividends for a whole year, you'll get paid typically 4 quarterly payments of whatever their total dividend is for the year. Each company sets their own percentage for what they're going to pay out in dividends over the year, and some companies don't pay a dividend at all. Those are typically the high growth stocks and tech stocks right now. So for you, a dividend is essentially like a rent check on your shares. Instead of owning a property and having a renter pay you money every month for owning them, instead it's like a stock that pays you money every quarter or sometimes biannually or monthly just for owning them. It's pretty sweet. A super important thing to know about the dividend is that it is not free money. So this dividend is always coming from somewhere, and where it comes from is the exact face value of the stock. So say the dividend is 20 cents. On the day the dividend is taken out of the stock and paid out to you, the shareholder, if it was a $100 stock beforehand, it would immediately be trading for $99.80. This is called the ex-dividend date, and that's ex as in Latin, which means from. So it's the day that the dividend is taken from the stock. So if you had a stock before that time, you would then be paid 20 cents, but the stock would then drop exactly 20 cents in value. It's not always easy to see this occur just because of price action before and after market hours, so you may not exactly see this occur, but it will be happening and you will lose exactly how much you were paid out in the value of that stock. Most companies will pay a dividend quarterly, so 4 times a year. Other companies, like Disney, will pay a dividend biannually, so 2 times a year. And of course, there are companies that pay monthly dividends like SPHD, not a company, but an ETF, and they'll pay that dividend monthly 12 times a year, in case you didn't know what 12 looked like on my hands. Regardless, a dividend is typically somewhere in the ballpark of 0.5 to 3%. Of course, some dividends can be lower, they can be down to 0, and then some dividends can be higher, up to 11 or 12%. You want to be a little skeptical if a company decides to pay out an 11 or 12% dividend, because maybe there are some other things going on inside that company that aren't so favorable, meaning that they need to pay out their shareholders more to continue holding their stock. Do your own research and make sure you choose the stocks that are right for you. Of course, you can always find a dividend for a company under its dividend yield in the information tab. That number is going to represent a percent, and you have to divide that percentage by how many times it's paid out to figure out what you're getting paid at each dividend date. Also, if a company has already paid out a dividend for that year, you can usually find it on NASDAQ's website, and it'll tell you how much it was paid per share, and then you can figure out exactly how much you'll get paid per share next dividend date. So, why are dividend-paying stocks so controversial these days? Well, it has to do with this idea that if a company is paying people just to hold its shares, it's not reinvesting that money in growing and innovating. Take, for example, a company like Tesla or Amazon. Those are 2 companies that have grown at a blistering pace over the past year or so, and the way that they do it is, instead of paying a dividend, they reinvest their profits into innovation and growth and just improving their company so that their stock grows without a dividend. On the other hand, you have a company like Johnson & Johnson that grows significantly slower, about 10% year over year for the last couple of years, but they pay a dividend that has been increasing year over year, and that's partially why people like it. It's a safe dividend bet, and it goes up over time. Personally, I don't think these 2 things have to be mutually exclusive. There's a great company you've probably heard of called Apple that pays a dividend and has been innovating and growing significantly over the past couple of years. Of course, past performance does not indicate future results, but in my mind, it gives us this example that there is a possibility of doing both. Personally, I like dividends, so my portfolio contains about 60 to 70% of dividend-paying stocks and ETFs, and anywhere from 30 to 40% of high growth tech stocks that don't pay dividends. Of course, I hold other things as well, but that's primarily where I'm at right now. Last thing, should you reinvest your dividends? My stance on this is 1000% you should reinvest your dividends. I don't think you should take them out to pay for new shoes, and I definitely don't think you should leave them in your brokerage account just to sit there being sad and alone. But if you use a brokerage account that doesn't allow you to buy fractional shares, the method in which I do it probably won't work for you. I like to accumulate $1 to $3 in dividends, watch the market for a couple of days, and then buy in when I feel like I'm at a better entry point than perhaps an all-time high. However, this isn't always going to work, and sometimes I could miss out on big days for this, but it's just the way that I like to do it. Of course, if you're going for convenience, automatic dividend reinvestment is perfect. It's something you never have to worry about, and it means your money won't just sit in your brokerage account all sad and alone. Again, like I said, if you can't buy fractional shares, my method really isn't going to work for you. But if you can, maybe it is. Maybe it is something you want to do, and maybe you want to take those other shares you have, maybe you have some other blue chip stocks that pay dividends, and reinvest them into something else. That gives you that option as well, instead of just automatically putting it back into those stocks. And then if you were to cash that out, you'd have to pay short-term capital gains on that, which also isn't ideal. So that's my method. And of course, convenience, whatever your choice is, it's got to work for you. So that's that on that with dividends. They are essentially a share of a company's profit pie that gets paid out to you, the shareholder. However, they come at a price, not only to the actual share price itself, when the dividend gets taken out on the ex-dividend date, but also theoretically to the future value of the company if they're not growing and innovating and instead just paying off their shareholders. Should you reinvest them? I think yes, you should absolutely reinvest them, but automation is only really good for convenience in this situation. If you have 5 to 10 minutes a day and you want to put in the work, you could theoretically wait for a slightly better market entry point to put them in and get a slightly better price, or you could just go with automation. Again, your system's got to work for you, and anything you can do is better than just letting those dividends sit sad in your brokerage account or paying for new shoes. Unless you want to live your life, then do that too. I personally like dividends a lot because they make me feel like I'm collecting rent in a game of Monopoly, and they add to the compound interest rocket ship that I'm currently building out on my launch pad. If you like this video, please consider sharing it with someone you know that's looking to build a gravy train of their own, ideally out of dividends, and maybe they don't even know it yet. Also, if you don't mind tossing this video a like, that would be super helpful, and subscribing if you want, that would be super cool too. Either way, I appreciate you for watching this video. Thanks for everything that you do. And if you have any interest in supporting my channel, you can click any of the links down below to create a number of free brokerage accounts, and you get a guaranteed at least $50 between all 3 or 4 of them. And that's pretty sweet. In stocks and cryptocurrency, if you want, you can turn around and sell them right away and walk away with $50. That's cool with me. I'd appreciate it, and I'll see you in the next one. Bye.